Well, Robert, thanks for coming in. It's early in the year, and in the fixed income universe, it's a pretty unique time. Even just recently, the RBA have talked about the fact that they're going to keep rates at all-time lows, increase their bond purchasing program. So a really awesome time to have someone from a firm like PIMCO talking with us. It is a global name. Can you tell me a bit about the culture of PIMCO? And you've been there for 18 years. What's it like inside?
Yeah, as we were saying, James, it's time flies. I'm somehow surprised that it's 18 years later. The PIMCO culture is really built around sort of excellence in investment, but we have acknowledged from way back that clients come first. And if you don't have clients, if you're not putting them first, you really don't have a business. So that's sort of been a huge driver of our culture. The other thing I'd say is we've always been quite disciplined around splitting up responsibilities. So whether it be investing or business management or client management, I think that's allowed us to have lots of focus on finding alpha for our portfolios and getting some investment insights. So I think that's been a huge advantage that we've been able to carry as part of our sort of inbuilt culture.
Yeah. Now, Aussies have an absolute love affair with equities, and everyone seems to know equities inside out. Bonds, not quite as well represented despite the size of the market. Globally, it's a really major asset class. What's the appeal of fixed income and bond investing for you?
Yeah, it's a good question. It sort of reflects my past. So my first role out of university was as a credit analyst. And so I was working for Bankers Trust, and I know there's so many of the Bankers Trust alumni out there that have sort of gone off and done other things. My background was on the investment bank side of Bankers Trust rather than BT funds. And so working as a research analyst, I sort of started to look at companies from a bottom-up perspective very early. And then mid-90s moved across to JP Morgan and set up their first corporate bond fund, actually the first corporate bond fund in Australia. Mm-hmm. And so it was really just that credit background that took me down the fixed income path. And I've almost backfilled all the macro understanding since then, rather than sort of starting at macro and working down into credit and corporate bonds and other asset-backed securities, etc. So I sort of ended up in the bond market by default. I guess it's, as you say, it does bring its challenges because a lot of people want to talk equities in Australia. But it's many times it felt like you were bashing your head against the wall, trying to have investors in Australia actually understand what the bond market was. But very interestingly, more recently, despite the fact that interest rates are at all-time lows or very close to, there's very few bond bears left. There was lots of noise around the being wary of bonds, and it's sort of all dissipated, which is quite peculiar given the level of rates.
Right. Can you go into that a bit more detail? What do you mean? Like, I thought the perception was that the return on bonds was so low that was, there was a bit of a cacophony of people out there saying that bonds are in a bubble. You're saying the opposite?
Yeah, so it's one of these things where, as interest rates have been coming down, and obviously been coming down in some places for a decade consistently, here we've had a little bit more volatility in terms of central bank parts. But it was more around this notion that if you own a long-dated bond, you're at the whim of interest rates repricing higher. And so PIMCO's mantra of lower for longer was dismissed by many for literally almost a decade. So this whole concept of new normal, new neutral that PIMCO came up with.
Secular stagnation.
All these things, yeah, exactly. So all of that was not really bought into for the whole ride down. Now that we're at the bottom, and as you mentioned about the RBA, again reiterating in the last couple of days that interest rates will probably be where they're at now until 2024, it finally gives investors some level of comfort that interest rates are staying lower for longer, and then we should be embracing that. So even for equity investors or other sort of more aggressive risk asset investors, that's a very comforting backdrop that monetary support will be alive and well for an extended period.
If you take that 3-year view out to 2024, what does that mean for the return from bonds? Because they play a number of roles. It's a diversifier. They offer liquidity and defence, which they showed last year in the sell-off. But an important part is the coupon. Yields are being suppressed. Does that mean people need to think about them for two main purposes and less so for the return?
I think it definitely means a range of those things, exactly as you said. But I think the other takeaway for us as an active bond manager, it means you can't be lazy. Like if you're lazy in your portfolio and you do nothing, you earn 10 basis points. Like no one wants to earn 10 basis points. So you have to be creative. You have to look at bottom-up opportunities. You have to look at potentially taking advantage of your liquidity premium. You have to think about the whole portfolio context, like just putting it in a passive bond fund, owning government bonds. I think it's a very bad idea. There's so much opportunity in the bond market to take advantage of, and when you've got a 10 basis point starting point, then you cannot be lazy. You need to be really looking for those opportunities.
Yeah. When we caught up in July last year, we had a bit of a chat, and you talked about investing in the reality of the world around you, and you said a lot of people tend to invest in how they hope the world will look or what it may look like. Great time to have a look around where we sit today. What's the reality of the world that, as from your perspective, in the world that we're investing in at the moment?
Yeah, I think the reality for us is that the very strong policy support will continue. And so when you do have that tailwind of policy, you want to take advantage of the assets that benefits. And so clearly equities has been one, and the ability for equities to stay buoyant is pretty good. The other areas to focus on there are some of the forgotten sectors that were downtrodden due to virus impacts. So things like tourism, things like airlines, things like airports, that are, again, slowly recovering, but very slow. We think the policies will continue to support those, and the fundamentals will eventually kick in as well. And then it's also a matter of saying that even if and we've talked about this a bit before, James, that even if your base case is a positive one, none of us have crystal balls. Like we're all giving probabilities to different scenarios. So when I say think about the reality of the situation, is you need to say, okay, well, let's not put all our eggs in one basket. Let's think about what happens in alternative states of the world and build diversified portfolios and stress test them and make sure that they stack up in the reality you think you're in, and the alternate realities that definitely don't have a zero probability of playing out.
Yeah. Well, as we've alluded to a few times, the RBA target rates, 10 basis points. You've talked about needing to be active and being proactive in finding opportunities. I was hoping you'd get a bit more specific and just talk me through, perhaps in the Australian context, a couple of the opportunities where you think there's some good value available.
Yeah, so it's again, it comes back to some of those underlying corporate sectors I referenced. So things like airlines, things like airports.
And this is specifically credit opportunities?
Yeah, exactly. So in the credit space, that they're all bond issuers. All of our airports issue bonds, similar to our flagship airline. So those sorts of things are taking time to recover. Obviously, their businesses, the cash flow of the generation of those businesses is under pressure. Yep. Yet they're virtually monopoly assets in many cases that will recover, and they'll recover very strongly. Fundamentally. The other thing to think about is what assets you can buy and hedge them back to Australian dollars. So what part of my mandate, again, part of the bottom-up background that I had, I'm responsible for our global credit fund that we distribute in Australia. So then you can be thinking about yields that are multiples of that 10 basis pointers in terms of expected returns. Obviously, we don't promise return, but expected returns more in the 2 to 3% range versus an inflation rate that's barely able to sort of break out of the mid 1% range, again, which was reiterated again from Governor Lowe. So those sorts of things as a starting point of 10 basis points and being able to then generate more like 2 to 3 percentage points. And then also moving more into the illiquidity space. I think that's the one risk premium, and again, we've talked a little bit about this before, the one risk premium that still has value. So when it comes to investing, you really have to say, if you don't want to earn 10 basis points, what do? You say, will I underwrite equity risk premium? Will I underwrite term premium and buy much longer dated bonds? Or will I underwrite illiquidity premium? And we would argue that most of the premiums are very full. Like there's not much value left in equities. I'm not saying they're going to go down, but the upside that we saw last year is not going to be repeated. It's very, very unlikely. But illiquidity premium is probably underrepresented in most Australians' portfolios, even though there's plenty of scope to say, let's lock up our investment for 5, 7, maybe even 10 years. And instead of earning 10 basis points, let's try to earn 10%. But mainly through identifying very high quality cash flows, but not wanting to trade them every day and be willing to give up some of that, give up some of that portfolio liquidity.
And what sectors is that? Is that, as you talked about, so airports and those sorts of things. Is that illiquidity premium available there? I mean, they sound like they'd be pretty widely traded sort of securities. So I'm figuring you're finding assets that aren't in the public view.
Yeah, those sorts of assets in the more liquid space are the sort of 2 to 3% returning assets. Yeah. The other ones would be further down the capital structure, further down into the high yield market, into the private credit markets. Some of the things we're doing there is partnering in terms of aircraft leasing, where the collateral values have plummeted. Things like, as I mentioned, private credit, especially in real estate. There's obviously been a big sort of shift in terms of the quality of some bricks and mortar real estate versus online retail, and some of those areas that we think have been completely misvalued in terms of that transition. Some assets in that space will probably never recover, but there's a cohort that will do well in almost every state of the world. So it's a matter of cherry picking those, but by definition, we would only put those sorts of instruments into portfolios that don't provide daily liquidity, because those assets are not liquid. So it means a different decision from the client base. And I'd say encouragingly, we've seen a huge shift in terms of our own clients in Australia over the past year or two, willing to make those longer term investment decisions in order to generate those higher expected returns. Yeah,
interesting. One of the things that you also talked about, mid last year was that you're expecting to see opportunities in distressed debt. I was just keen to see if you're starting to observe these kinds of opportunities, because I think a lot of people, and even again referring to the RBA governor, he said he was surprised by the recovery. Things seem to have been quite orderly, and the expectation that there's going to be boarded up shop fronts, maybe has not materialised to the level people were expecting. So I was just keen to get an understanding on that view and how it's progressed and how it's evolved.
Yeah, we would agree with that. So if you look at insolvency rates, they're actually very low. If you look at default rates across sort of global bond markets, corporate bond markets, they're very low. So there's very few casualties so far, actually fewer than there would be in a normal economy. So we think there is still some return to normal that's inevitable. It probably won't be some of the sort of the most obvious examples. So there's going to be some areas of retail real estate that remains under pressure for a long time. But again, a lot of those places can be converted into residential real estate. So there's not a natural, you don't just assume whichever industry was under the most pressure in the short run will be under the most pressure in the long run. So you're right that some of those areas are taking longer to materialise. Credit spreads have been obviously recovering quite well, but we've still found plenty of things along the way. So as I mentioned, looking at very bespoke opportunities to populate some of these locked up vehicles, we're still finding plenty of things to do there. Yeah. But it's not finished. Like the rollout and the impact of the pandemic, we don't think that removes the probability of defaults forever. It just delays some of the, maybe there are some more zombie style companies out there that have been able to get a lifeline that would otherwise have been under a lot more financial pressure by now.
Now, inflation has been a bit of a point of interest and a topical debate with a number of investors that I've spoken with. And I think, people are starting to see signs, house prices rising, commodity prices have been strong, people talking about potential wage increases, that sort of stuff. Keen to get your perspective on inflation and if you see it as a potential threat. Is it in your forecasts over the next few years? How are you thinking about it?
Yeah, inflation is something that investors should always have in the back of their minds because it's something that can completely change asset return outcomes. So our take at this point is a couple of things. The first thing is that investors have to acknowledge that central banks, including the RBA, have said we want to see inflation above the bottom of our range for a period, an actual observable period. They're not just going to start hiking rates when they see inflation on their forecast sort of moving into the range. They're going to wait to see it actually happen. So that means we are going to eventually be in an environment that's got higher inflation than we're used to. But in the same voice, they're saying that they're hopeful that they can at some point achieve that outcome. And so far they haven't been able to. So we have to say, well, the short-term risk around inflation's low, but as we start to see inflation get some traction, as an investor group globally, we should all be cautious because they're going to let it run. If they can generate some, they'll let it run a little bit longer. So we don't think that's on our doorstep. So it's maybe 2 or 3 years away. But in terms of preparing for that, there's certain things investors can do, and we do. We think about the shape of a yield curve, how will it steepen when you've got the front end of a yield curve anchored because of policy, the back end of the yield curve supported through QE and other things depending on the jurisdiction, but also more vulnerable to higher inflation if it occurs. The question mark then becomes, as soon as, so one of the big areas for investors to think about is, if we start to see, as you mentioned before, around JobKeeper, etc., if we start to see fiscal policy get pulled back at the very first opportunity, because there's a level of uncomfortableness associated with running big budget deficits. If fiscal policy gets pulled back too early, then I think that inflationary impulse will evaporate. So it's a lot of these things to, yeah, exactly. We're not ready at a, again, the Prime Minister here has mentioned that, and the Treasurer has mentioned that if unemployment is sustainably below 6%, that they would like to start easing back on fiscal policy. Whereas the Reserve Bank wants to see full employment before they're willing to start to ease off on, and wage pressure before they'd be willing to ease up on monetary policy. So again, we may get into this mismatch between the heavy lifting of monetary versus fiscal once again. As I mentioned, fiscal did a great job in 2020. It just remains to be seen how long that lasts for. So depending on that mix of policy globally will be a big determinant in terms of when investors should start to worry about inflation. But as I said, it's probably a couple of years away.
I guess if we were to boil that down into an action point, I'm not suggesting people take action right away, but when speaking with equity investors, they've talked about some of the parts of the market that are more resilient in an inflationary environment. What are the steps as a fixed income investor that you take, to to protect capital in an inflationary environment.
So for us as an active manager, the first part of our active decision is interest rate risk. Do we want more or less? So we talk about that literally every day. How do we want to position portfolios? How do we want to do that across the yield curve? Obviously, there's some very inflation-friendly bond instruments like floating rate notes and index-linked securities that are available to switch into if you thought that inflation was bearing down upon us.
Yeah.
The other thing to bear in mind, though, is that as part of that quantitative easing and monetary support process, the central banks want to ensure that we do get some of that traction in terms of economic growth. So they're incentivised to keep yield curves under some form of control.
Yep. They're orderly.
The last thing they want is some sort of taper tantrum. And the first central bank in the world that creates any form of uncertainty, and again, RBA confirming that they'll extend QE, the first bank that generates any form of uncertainty and has a big rally in their currency will end up having a problem with their economy a little bit later down the track. So central bankers globally will be somewhat cautious around taking that first step to take the foot off the accelerator by keeping policy rates low and also keeping yield curves under control.
Mm. Do you see a time where the level of intervention and control from central banks and also on the coordinated fiscal response, do you see a point in time where it's less involved?
It's a great question. I would hope so, but again, comes back to what you hope for versus what you think's reality.
And the composition of the PIMCO
advisory
board.
Exactly. So I'd say I would hope so, but I would doubt it. And so if you think about some of the permanent outcomes from the last decade, which was put on to sort of hyperspeed or accelerated mode in 2020, is the level of global indebtedness, which has continued to go up. And we know that whether it be households in Australia or global governments that are heavily indebted, that bankrupt themselves with a lot higher interest rates. So I do think that whether it's central bank involvement directly, whether it's a new neutral style, much lower interest rate that becomes more permanent, one of those two I think is with us for sure, if not both. So rates lower for even longer.
Well, 2020 was an incredible year. We've developed a little series at Livewire where we're asking some of the investors about some of the incredible stats. And I was just wondering if you could pick an incredible statistic from the fixed income markets that stands out to you that you could share with our viewers and readers.
Yeah, so it's a pretty simple one, but as you said at the start, Australian investors haven't really looked at the bond market as much in terms of their attention's been focused on equities, and we've had this discussion before, James, too, that the bond market globally is actually larger than the global equity market. So there's not a dearth of opportunity there. It's a massive opportunity set. And of that market, more than 50% of it are not government bonds. So again, we've got an opportunity set out there that's literally more than half the size of the global equity market purely in credit instruments. And the way that market evolves is incredible to the extent that we see new issues every single day. It's like IPOs in the Aussie equity market are reasonably rare, whereas we're literally seeing new bonds created every single day from different companies, from different governments, even from emerging market governments. So it is a very different backdrop and provides us as a bond manager with a changing opportunity set that it evolves every day.
Great. Well, Robert, great to have you in at the start of the year. Glad we're able to do it in person this time around, and thanks for sharing some of your views.
Great, thanks so much.